Hello everyone, welcome back to the FinTech and the Financial Inclusive Executive Program. Today we will deep dive in the financial inclusion. First, let's know what we mean by the financial inclusion. Financial inclusion is a term that is referring to the efforts to cover all individuals, organizations by the financial services, especially for those who are underserved or they cannot benefit from the banking or financial services and products. The services that these individuals or organizations can benefit from the banking services, savings, loans, insurance, and other financial tools that can help them to manage their financials, save for the future, protect themselves against any financial risks or any other types of risks that can be related to the financial factors. So what is the key components of financial services to know more about the financial inclusion? We have to know the key components. One of the most important key component is to have an access to banking services either by using the technological services or from the areas that cannot be served by traditional banking services. So accessing to the banking services is one of the most critical component of the financial inclusion to allow individuals to securely store and manage their money and access all financial services, get benefit from all financial products. The other component, and it is very critical, it is digital financial services. So they can use the technology, access these financial services through a mobile banking application and use the online payments. They also can use digital wallets, and this will play a crucial role to expand the financial inclusion, especially for these regions that is not covered by the physical infrastructure required to have a physical bank in these areas. We have another component such as microfinance and the microcredit to provide people by small loans and financial services to entrepreneurs and small businesses in low income to help them to grow and provide them by the financial services that is required for their business growth. We have the insurance services as a key component for the financial inclusion to offer an affordable, accessible insurance products that can protect individuals and businesses from financial shocks that has been caused by some events like illness, natural disasters, or accidents. We have also the financial education that is promoting the financial literacy, which is very essential to ensure that all individuals can understand the basic financial concepts and make an informed decisions based on insights and data will be available for individuals or organizations so they can effectively use the financial products and services. In order to support the financial inclusion, governments introduce some initiatives to implement some policies, programs to promote financial inclusion. These initiatives may include regulatory reforms, subsidies, and incentive to encourage financial institutions to serve the underserved populations. We have an also collaboration between the public and private sectors to have a partnerships between government agencies, financial institutions, non-profit organizations, and the private companies that is critical to create a holistic approach for financial inclusion. We will cover now the importance and the challenges of the financial services. The importance of financial services, we have many benefits that we can list all of them here, but we will cover the most important benefits of the financial inclusion. And the first and highest priority is the poverty reduction. So financial inclusion can empower people to break the cycle of poverty by providing them tools to save, invest, and access credits. We have also another benefit is economical growth that will happen if people can use the financial tools and have the required proper access to credit and capital, enable the entrepreneurs to start their businesses or even expand their existing businesses to create jobs, posting overall activities. The risk mitigation, which is insurance and other risk management tools that provide that is provided under the financial inclusion umbrella and can help individuals and small businesses to mitigate the impact of the unforeseen events, because the small businesses are vulnerable to the unforeseen events or to risks of the financial or markets instability that may affect them and affect their organizations heavily. So these tools will protect small organizations against some risks. In addition to the health crisis and natural disasters may affect individuals, we have also education and health improvement. Financial inclusion can contribute to the better education, health outcomes. Families with access to financial services may find it easier to afford education expenses and health care. Gender equality, one of the most important benefit in the financial inclusion is the gender equality. So you can provide women the access to financial services so they can enhance their economical life, independence, and contribute to more equitable societies. Innovation and entrepreneurship, accessing to financial services fosters the innovation and entrepreneurship, where the small businesses and startups can rely on financial support to fund their ideas and bring products or services to market. Enhance financial security. Accessing to financial services can enhance also the financial security, reduce the vulnerability and exploitation to predatory lending practices. Infrastructure and accessibility, one of the most important challenges to financial inclusion, because the lack of physical infrastructure, such as banks and ATMs, will make accessing to financial services is difficult. We have also the financial literacy is one of the most important challenges. So we have to learn individuals, especially in the low income communities, by the benefits of the financial inclusion and how they can get benefit from the financial services and financial products. We have also regulatory barriers. So in some countries, they don't have the required regulations may allow the use of technology to accelerate the piece of financial inclusion. So this barrier, it has to be removed by creating the required regulations that allow such services in these countries. We have also the technological barriers where digital technology is very important to enhance financial inclusion, of financial inclusion. Some populations lack access to smartphones, internet, necessary digital literacy. Also, we have the lack of trust as one of the financial inclusion challenges, where some cultures still reject the use of technology and have no trust in the financial systems. There is a limited product offering in some communities, and the last challenge here is a social or socio-economic factors such as unemployment, income inequality, social exclusion, which create barriers to financial inclusion. Now we will discover the role of fintech in promoting financial inclusion, where digital payments will promote the financial inclusion and introduce some solutions to facilitate the digital payment systems, including mobile wallets, peer-to-peer payment platforms. Such tools will allow individuals to have an access to traditional banking services to make transactions digitally and securely, efficiently, while mobile banking applications can provide a convenient and accessible way for the individuals. This will allow these individuals to manage their financial transactions, check account balances, transfer money from their own accounts to other accounts, and access other financial services using their mobile phones. The benefits of mobile banking is not uh, limited to these services, but it bypassing the limitation of having physical banking infrastructure in such low-income communities. We have InsurTech services, which introduces some insurance solutions based on technology solutions or technological solutions. So all insurance products will be more accessible and affordable. So fintech will enable the development of micro insurance products tailored to specific needs of low-income individuals and small businesses. Biometric authentication is very important to secure digital transactions. These biometric authentication may use a fingerprint, iris scan, and this will allow to enhance the security of financial transactions. And this will be very useful in the areas where individuals may not have traditional identification documents. In data analytics and alternative credit scoring, fintech companies will use advanced data analytics to assess creditworthiness based on the alternative data sources, and it will allow them to extend financial services for some individuals who lack traditional credit history and enable more inclusive lending practices. Robo-Advisors is one of the most important fintech business models that is dependent on the algorithms that provide automated and affordable investment advice. and this will make investment opportunities accessible for individuals with limited financial resources and promote the wealth creation and financial inclusion. Education and awareness fintech platforms can incorporate educational components to enhance financial literacy and provide all required information about financial products, services. So, fintech will contribute to build an informed and empowered user base, and also it will play a crucial role to support governments to promote digital payments and disbursements, facilitate the delivery of subsidies, social benefits, and other financial services to broader population. We will demonstrate now some case studies and success stories, such as M-Pesa in Kenya, which is a mobile money platform that is originated in Kenya, launched 2007, that allow users to deposit, withdraw, transfer money, pay bills, and access other financial services through their mobile phones. This platform has had a significant increase in financial inclusion in Kenya, especially in rural areas where traditional banking infrastructure is very limited. In India, there is a significant strides in the financial inclusion through implementing India Stack, a set of open APIs that leverage a unique identification system known as Aadhaar. Aadhaar is providing a biometric-based identification system for residents, enabling them to access various sources, including financial ones. The combination of Aadhaar and the India Stack has facilitated the delivery of government subsidies, improved access to credit, enhanced the overall efficiency of financial services. Tala is a fintech company that leverage alternative data and mobile technology to provide microloans to individuals without a traditional credit history. Operating in emerging market, Tala has successfully reached underserved populations, allowing borrowers to build credit and access financial services that were previously unavailable to all individuals. Branch International is a fintech company, provide financial services such as mobile loans to individuals in Africa using smartphone data to assess credit worthiness. Branch has extended financial services to individuals who lack traditional credit histories and provided innovative approach to contribute in the financial inclusion spread in the region. We have Pradhan Mantri Jan Dhan Yojana. This is a financial inclusive initiative launched by Indian government, and this program aimed to provide access to financial services for all households in India, especially those in rural area and low-income areas. This initiatives this initiative is a part of millions of bank accounts were opened and individuals were provided with debt cards, and the integration between Aadhaar and the mobile technology has further enhanced the effectiveness of this initiative. We bank founded by Nobel laureate Muhammad Yunus. Grameen Bank is one of the microfinance institutions that has already played a crucial role in promoting financial inclusion in Bangladesh, provided small loans for poor individuals, especially for women, to support entrepreneurship and economical self-sufficiency. Grameen Bank model replicated to various parts of the world. In Tanzania, mobile money services such as Vodacom, M-Pesa, Tigo Pesa has leapfrogged traditional banking infrastructure. These services adopted allowed individuals to make payments, transfer money, access financial services using their smartphones and increase the piece of financial inclusion acceleration in the country. To measure the financial inclusion, we have many measures and factors that can allow us to measure the spread of financial inclusion. These indicators can be the uh, to uh, to make some reliable performance indicators and survey mechanism. They can use uh, some of measures such as access indicators, the penetration of bank branches, point of sale, the and the barriers that is avoiding the access to financial services. They have also some KPIs such as usage indicators, regularity and duration of financial services, product services over the time, such as average saving balances, number of transactions, number of electronic payments. We have also quality indicators, the range of options available to customers, client awareness. We have some categories such as formally bank adulted. We have some indicators such as the percentage of adults with an account, number of depositors, percentage of adults with at least one loan outstanding. This one in the category of that adults with credit by regulated institutions, percentage of adults, number of borrowers per 1,000 adults. We have the category formally banked enterprises, the percentage of SMEs, small, medium enterprises with an account at a formal financial institutions, number of SMEs with deposit accounts, enterprises with outstanding loan or line of credit by regulated institutions. We have a category for points of services, the number of branches per 100,000 adults. Um, we have some trends in the financial inclusions, such as closing the gender gap, prioritize banking over banks, collaborative or collaborations with will be the key, human touch. The barriers for financial inclusion is the lack of money or insufficient fund, the high cost or fees to get benefit from the financial services. As per the International Money Fund data, highlight that the maintaining a basic checking account and performing essential transaction can cost low income users more than 5% of their monthly income. Physical distance, lack of proper documentation, lack of distrust in financial services. These are some references. We will mention it in our in the first comment of this video. Okay, now we will start by the quiz of module 2. The first question, what does financial inclusion aim to provide individuals and businesses in underserved communities? Access to luxury goods, access to financial services and products, which is very convenient and right answer. Access to entertainment services, access to educational resources. Thank you. The answer is B. Which of the following is considered a fundamental step towards financial inclusion? Online shopping, opening and maintaining basic bank account, social media engagement, health insurance. What is your answer? Correct. Opening and maintaining basic bank account. How has technology such as mobile banking, online payments contributed to expanding financial inclusion? By limiting access to financial services, increasing physical infrastructure play a crucial role in regions with abundant physical infrastructure, providing convenient access to financial services in regions with limited physical infrastructure. Yes, the answer is D. What is the role of microfinance and the microcredit in promoting financial inclusion, supporting large corporations, stimulating economic activities in low-income communities, limiting access to financial services, encouraging overspending? The right answer is stimulating economic activities in low-income communities. The answer is B. How can financial education contribute to financial inclusion? By encouraging overspending, by promoting financial literacy and informed decision making, by limiting access to financial services, by discouraging entrepreneurship. Sure, by promoting financial literacy and informed decision making. What are government initiatives for financial inclusion likely to include? Reducing access to banking services, which is illogical. Implementing regulatory barriers, no. Offering subsidies and incentives, yes. Discouraging collaboration between sectors, no way. So the right answer is C. What is the collaborative approach crucial for in achieving financial inclusion? Encouraging competition among financial institutions, fostering a fragmented approach, creating a holistic approach, ignoring private companies' involvement. Thank you very much. Holistic approach is very, very useful for achieving or accelerating the pace of financial inclusion. How is financial inclusion connected to the United Nations Sustainable Development Goals? Goal number 1, no poverty, good health and well-being, gender equality, no poverty. Goal number 1 is no poverty and zero hunger. This is the and goal 8, decent work and economic growth. So the right answer is D. What is the one of the challenges of financial inclusion related to infrastructure? Lack of regulatory barriers, abundant physical infrastructure, limited access to banks and ATM rural areas, excessive financial literacy in urban areas. Yes, this is the one or the most correct answer. What can hinder the effective use of financial sources? Sorry. Especially in low-income communities, regulatory barriers, lack of financial literacy, abundance of financial products, government subsidies, lack of financial literacy. What is the potential barriers to financial inclusion related to technology, lack of digital literacy skills, abundant access to smartphones, excessive use of digital wallets, high reliance on traditional banking methods? Lack of digital literacy is one of the most important barrier, and it is very important to focus on digital literacy. Why might there be a lack of trust in normal or formal financial institutions in some cases? Cultural factors, abundance of financial products, high levels of digital literacy, historical experience. Cultural factors, very, very important when you are going to establish a new business model and in your country, in other countries, you have to study the external environment. One of the most important factors in the external environment is the cultural factor. You can do your best analysis. Best analysis is the political, economical, social, technological, legal, environmental factors. One of the social, one of them is a social factor, which is includes a cultural factor. What the 13th question, what is the essential for overcoming challenges in financial inclusion? Offering limited product offerings, ignoring socioeconomical factors, comprehensive and collaborative efforts, increasing regulatory barriers. Thank you. Comprehensive and collaborative efforts is very essential to overcome all of financial inclusion challenges. How does fintech contribute to digital payments in the context of financial inclusion? By restricting access to digital payments? No. By introducing physical payment method? No. By facilitating digital payment systems, including mobile wallets? Yes. By discouraging mobile banking applications? No way. So the right answer is C. The last question, how do fintech companies use alternative data sources in digital lending platforms to enhance financial inclusion? By limiting access to loans, by discouraging lending practices, by assessing credit worthiness and making it easier for individuals to access loans. Very logical. By avoiding the use of advanced algorithms? No. So the right answer is C. Thank you very much for attending today's episode. Please wait us for the other episodes in the FinTech and Financial Inclusion Executive Program. See you. Goodbye.